So very warm welcome to all and welcome all to today's webinar on expectations from the Union Budget 2025 by Access Direct. My name is Rohit and I'll be your host for this evening, and I'm having with me Mr. Neeraj Chadawar with me. But before we go on, I just wanted to make sure that my voice is audible to you all and screen is visible. So those who are attending this session from our WebEx channel, on the bottom right side corner, they can see the chat section and they can go there and click on this that my voice is audible. And those who are attending this session from our YouTube channel, they can go into the live chat section and just type yes that my voice is. So thank you so much for the confirmation. Once again, welcome all to today's webinar on expectations from the Union Budget by Access Direct. My name is Rohit, and I'm having with me Mr. Neeraj Chadawar, who is the head of quantitative strategy with Access Direct, and who is going to give you the view on budget and the most highlighted sectors, insight, and overview on the macro and micro views. So with this, I'll hand over my session to Mr. Neeraj, and Neeraj, all over to you now. Thank you so much.
For our special session on pre-budget expectation with the hashtag Ummeedon Ka Budget. So in next 15 to 20 minutes, I will take you through couple of topics. So I will try to cover what to expect from the upcoming union budget, what is the current state of macro and microeconomic situation, what are the different sectoral opportunities available, and what could expect. Based on that, what could be the stock ideas possible. So before proceeding, so this is our standard disclaimer, which we proceed with this. Let's get begin. So the well-known topic, our union budget, which is scheduled on 1st of February. Our finance minister present the 12th budget in this room. This will be a balance. What we expect from this upcoming budget, this will be a balance act between the capex spending and the social reform. That's why we call it as a Ummeedon Ka Budget. What it is known that the expectations in last many years. Why so? Because most of the actions or the policy reform government take out of the budget preview. So the expectation has reduced in last couple of years. But this time around, the expectations are different. Why this time around the expectations are different? Because the current macroeconomic situation is little bit different, and with this challenging current macroeconomic condition, we are entering into the budget. So the hopes from the budget has increased significantly. So before presenting the hope, let me spend some time about what are the different macroeconomic challenges which we do right now. So let's start with the first half of FY25. For the first half of FY25, we have seen that there was a cyclical slowdown in the economy. There was a multiple factor which was contributing to the cyclical slowdown in the economy, which was related to the reduction in the government spending, tightening in the unsecured lending, consumption slowdown in the urban area, which was the very known factor in Q1 earning and the Q2 earning, extended monsoon, and up to certain extent some pockets of inflation. All these factors have contributed to slowdown in the economy as compared to the previous quarter, and based on that we have seen slowdown in the earnings of the Indian corporate. We know that the first half was most attributed by the election, then this government has formed little later, then the budget was presented on 23rd of July. So again the allocation to ministry has get get delayed. Then we had a extended monsoon. So all these have contributed to down in the capex for the first half. But in the second half, there was a scene that there was a good amount of uptick seen in the economy during the time of festival season. The monsoon was good, so the Kharif fasal was very solid. The reservoir level was very solid, so that was the promising news for the Rabi crop. And based on that, after the verdict of Maharashtra election, we have seen that again the capex spending back to the market. But the overall capex spending was targeted for 11.1 lakh crore, and based on the small uptick in H1, we believe that there will be a short out of 11.1 lakh crore, what we believe that government will able to spend 9.5 to 9.7 lakh crore. So there will be a shortfall in the capex spending. Due to slowdown in the capex spending, due to consumption slowdown, inflation, on top of that, there is a risk which is coming from the global market. Global market, the US market is behaving in a different way. Right now, we are seeing that the US bond yields are spiking. The the dollar index is also spiking. And due to spike in the US 10-year bond yield, FIs are continuous last 3 to 4 months. Even in 2025, for first 21 days, they are the net seller. The biggest thing was watched by the market participant in last couple of days was 20th of January event when the President Trump sit on the chair. There was much anticipated that after sitting on the chair, there will be a series of announcements from the US administration. And due to that, we were seeing high amount of panic selling by FIs in last couple of days. But what we are seeing from last couple of days, the news flow has reduced, and there will be a distribution in the news flow, and the distribution of news flow has scattered from the US market, and the President Trump, we have seen some amount of tone down in his expectation. Due to this, what we believe that this will be a volatility for couple of trading session, and once this volatility settle, the market dynamics will look towards the upcoming budget and the ongoing earnings season. What we believe that in the market focus will domestic agenda, which is nothing to do with the US market. Very soon we will be looking at the domestic agenda, that is the upcoming budget and the ongoing earnings season. Now we are entering into the upcoming of slowdown in the consumption. Attributed what was the reason behind the slowdown in the consumption. So now, excuse me, so this time around, hopes are very, very solid or big from upcoming budget to spur the consumption growth based on certain reforms, certain measures. What we believe that this budget will likely to present or strengthen the narrative of Viksit Bharat by 2047, and government will likely to play a balanced act between growth and social reform. Now, vigilant in the upcoming budget will be the verdict of Maharashtra election. The verdict of Maharashtra election was the game changer for the Indian politics. The biggest driver behind the verdict in the Maharashtra election. This ruling government is known for the capex driven agenda, and what we have seen in last 10 budgets of the current government. What we believe that this government focus in last 10 years was more towards building national infrastructure plan, that is roads, highway, port, railway, defense, and less focus was given towards the rural or welfare scheme. That's why we had seen some amount of rural distress. The Maharashtra verdict will open the new forward some amount of allocation will be shift towards the social reform, and it will be likely to be a balanced spending and the social reform. What we believe that government will continue with the agenda of Atmanirbhar Bharat, Make in India, PLI scheme, all will likely to continue their traction in FY26, and some amount of social allocation will be allocated to provide benefit to the bottom of the pyramid. In that regard, some schemes would be expected towards to promote agriculture sector. Some allocation could be expected towards increasing increment of the farm income, and much anticipated for the middle class, that is relaxation in the taxes of the middle class in the new regime. That could be possible in the upcoming budget. So we remain vigilant, and what we expect based on the current scenario, these are the expectation, and government will likely to play a balance act between spending on the capex and the social reform. On top of that, what we believe that the focus of government will be on four major agenda going forward. The first will be higher capex spending. We know that in FY25, government has short in spending the entire 11.1 lakh crore. What we believe that government likely to close that number around 9.5. On top of that, 15 to 17% allocation is expected for the capex. In total, capex number is likely to be around 11 to 11.5 lakh crore. Government focus will continue towards building national infrastructure that is related to road, railways, defense, metro, green technology. All these will continue to remain under focus for the current government. Second is very relevant, that is higher rural spending. The pain area in the Indian economy in current context is the rural distress. The multiple reason that is that is due to the higher inflationary pressure. Due to that, this particular set of economy has not come out of the woods after the COVID world. We believe that there will be more focus given towards this particular section of economy in terms of some amount of reforms or some amount of allocation will be awarded to revive the rural India. On top of that, the biggest focus will be given towards boosting consumption and job creation, which is the need of the hour. We believe that more and more focus will be given towards putting consumption. That could be by giving some relaxation in the new regime of income tax. That could be one of the idea, or some amount of allocation could be given towards the mandri, or some amount of allocation could be given towards the kisan or farm incomes. All these are expected from the budget, and we believe that more focus will be given towards putting consumption and creating more and more jobs via manufacturing, via PLI scheme, via entrepreneurship. And at last, fiscal consolidation will be the biggest thing which will be keenly watched by the investor. What we believe that for FY25, government had set the target for 4.9%, and what we believe that this time around, government will likely to close this number below 4.9, around 4.7 to 4.8. The market will, because the capex spending was lower. What we believe that going forward, the FY26 fiscal deficit will be around 4.5%. Any change in the fiscal deficit will be keenly watched by the market participants. Nonetheless, what we believe that in next couple of days, the market focus will be shift towards the budget. What we believe that based on that, our pre-budget play from the coverage universe are Ultratech Cement as an infrastructure ancillary play, JW Energy and Kalpataru Power as a power play. We like also Rights Limited as a as a railway infrastructure, Maruti Indian Hotel as a consumption play, even Oberoi Realty as a consumption play, Praj Industries as we know that the biofuel, so the focus will remain on that particular sector, and VWAT again as a consumption play. We continue to like M&M from non-coverage universe as a rural play because government focus likely to be around the rural area. Abscon Infra as an infrastructure play for building metros and infra development. Vishal Megamart as a consumption play. Tata Power as a power reform play because we know that government agenda will likely to reform the entire power sector. More strengthening reform will likely to be visible in the upcoming budget. And at last, Anantaraj as a data center opportunity play. We believe that there will be more things on the card related to the data center opportunity, which is the next big theme in the upcoming years. So let's deep dive into the macroeconomic picture, 3rd of July, and where we stand. What we believe that on 23rd of July, government had set the net tax revenue of 25.83 lakh crore. Out of this, 18.7 lakh crore has already been collected between April to November, which is 8.7% higher than the last year. What we believe that government is on track in collecting direct and indirect taxes. As on 12th of January, government has collected 16.89 trillion lakh crore out of 22 lakh crore targeted for direct tax collection. It means that 77% of the budget estimate has already been achieved by 12th of January. We have seen robust amount of personal and corporate tax collection till now. The similar trend was seen in indirect tax collection, that is GST and excise duty. So government has also collected more than 61% of indirect tax for first 8 months of FY25. So based on that, what we believe that the tax collection for the government remained robust. The non-tax revenue, in which the maximum revenue government has gained from the RBI dividend. The RBI dividend was targeted for 1 lakh crore. The government has received 2.1 lakh crore. So this is a big positive for FY25 number. So what we believe that more all government will receive all the tax revenue in line with the expectation, and there will be less slippages possible for the fiscal deficit. So that is a positive number for which we are building for FY25. If I further divide FY25 where government is spending, so government spends in terms of subsidies. Food, they have targeted for 2 lakh crore, which we believe that which will going to meet. Fertilizer subsidy, they were targeted for 1.64 lakh crore. We know that this year the monsoon was great. The subsidy given was higher as compared to the budgeted number. And what we believe that we likely to close this number around 1,70,000 to 1,75,000 crore. There are slippages possible because the Kharif season was very good, and the ongoing Rabi was also very good. So some amount of slippage is possible in fertilizer subsidy. In terms of non-tax interest in line, RBI dividend, which was targeted for 1 lakh crore, what we have seen that 2.11 lakh crore is already been collected. So RBI dividend has given a room to government to manage the fiscal deficit for FY25. Going forward in FY26, this lever is not available with the government. So 1 lakh crore extra income this government has collected for FY25. This 1 lakh crore government will have to manage from the other sources of income. So that's why we remain vigilant in the upcoming budget, how government will going to target to cover this extra income in the upcoming budget. In terms of disinvestment, government has targeted for 50,000 crore. So till now, we have seen a good amount of slippages in that disinvestment. Till now, the disinvestment is around only 8,600 crore only out of 50,000 crore. So again, the number for FY26 likely to be in the same range, and not much anticipated disinvestment will be targeted for FY26. In terms of government major outlay, so the government spend their money with the help of multiple schemes. So the Manrega, they have given a good amount of target, 86,000. So upcoming budget, there are strong possibility to spur the consumption. This number could reach up to 1 lakh crore. The government focus in last couple of budget was around Pradhan Mantri Awas Yojana. So what we believe that more allocation will be awarded in FY26 for Pradhan Mantri Awas Yojana. Jal Jeevan Mission, National Rural Drinking Water Mission was awarded 70,000 crore. This time around, which we believe that more allocation will be given towards the Jal Jeevan Mission. The Swachh Bharat, then Amrut, modern of police services, all these things will remain focused in FY26. Coming down to infrastructure, which will be the backbone of the upcoming budget. In FY25, government had targeted 2.55 lakh crore for the railway. What we believe that there was a shortfall in the capex spending for the railway. What we believe that this time around, this number likely to be higher as compared to the earlier year. More and more allocation will be awarded towards railway infrastructure for building new railway station and upgradation of the railway stations, upgradation of the railway lines. On top of that, the focus will be more towards the railway switching system. That is the more focus will be given, and more focus will be given towards the upgradation of the railway coaches in terms of upgrading new Vande Bharat, and more announcement will be expected towards that. On top of that, the focus remains on building road, NHAI, smart cities, shipping, power, aviation, Jal Shakti, even the Pradhan Mantri Awas Yojana, all continue to remain under focus for upcoming budget. So this is the total expenditure budget. The total budget of expenditure was targeted at 48 lakh crore last year. What we believe that in FY26, there could be a possibility of increment of 4 to 5% in the total expenditure budget. So this 48 lakh crore likely to be around 51 to 52 lakh crore. Government likely to present the 52 lakh crore of budget on 1st of February. Interesting point to note that for FY24, the last year budget, government has targeted 4.55 lakh crore announcement for the defense out of 44.9 lakh crore. Last year on 23rd of February, government has targeted 4.54 lakh crore for defense out of 48.2 lakh crore. It means that the absolute number is almost similar, but the percentage allocation from the total budget has reduced in the last 1 year. And that is the reason we have seen that the order flow from the defense sector has reduced in last couple of quarters. This time around, again, we believe that the absolute allocation to the defense sector likely to increase from here onwards. And in terms of allocation, it is likely to be around 10% of the total budget. If the total budget is of 52 lakh crore, what we believe that defense allocation likely to be around 5 to 5.2 lakh crore. With this, what we believe that there will be the fresh ignite which possible in the defense spending, and that would be more likely to vigilant on 1st of February announcement. So this is about our mathematics of macroeconomics, how the budget is likely to present. So let's spend a couple of minutes on sectoral picture from each and every sector, what we are expecting in the upcoming budget, sector likely to remain under focus based on our expectation. So first and foremost is the infrastructure sector. As I was talking, there will be a higher allocation in terms of capex. So, there will be 15 to 17% higher allocation will be in terms of capex. So what we believe that this will be a very beneficiary for the national infrastructure building. Dedication allocation to the larger infrastructure projects like high-speed railway trains, smart cities, inland waterways, Jal Shakti, Jal Jeevan Mission will be continued to remain under focus. So based on that, what could be the impact? This particular thing will be positive for all the EPC companies like HG Infra, RITES, KPIL, KEC International, J Kumar Infra, Ahluwalia Contracts. So all these attraction from last couple of quarters, the order book has reduced due to slow uptick in the capex. So now going forward, if the capex spending will again back to the picture, the all order books will again back to the picture for all the EPC companies. So all these companies likely to be under traction. The next thing will be on the cement. So cement will be the infrastructure beneficiary sector. What we believe that cement is in a very solid space for 2025. What we are seeing that the government capex uptake was very low in FY25, and that is the reason we are seeing that volume degrowth in the cement companies from last couple of quarters. And on top of that, there was a consolidation in the cement industry where two big giants are in a M&A spree. What we believe that we are at the peak of the consolidation in the cement cycle, and what we believe that in next couple of quarter, cement will be the biggest beneficiary of profitability on profitability spree. What we believe that going forward, more all the major companies will focus on increasing the profitability by executing the efficiencies, and based on that the EBITDA per ton for cement companies in next couple of quarter onwards likely to improve on a YOY basis. And on top of that, the government focus will be remain on infrastructure building. So overall uptick in the capex on ground efficiencies for FY26 likely to be better than FY25. Excuse me. So cement companies will be in focus going forward. So what we believe that Ultratech, Ambuja, both companies will be the biggest beneficiary in the upcoming cycle. Coming down to utilities, power and ancillary. Excuse me. So utility and power companies will also to remain under focus because government agenda is to target 500 gigawatts of renewable energy by 2030 to 2032. Government will likely to strengthen that agenda, put up some policies as a part of National Electricity Mission. More traction will be given, more allocation will be given towards rooftop solar and adoption. Also increasing allocation for smart metering will be given. So what we believe that the utility and power ancillary companies will continue to be under focus for the upcoming budget. Coming to BFSI. So BFSI will be a neutral stance, and in the coming budget as a part of capex. Higher capex means higher credit growth in the upcoming quarters. So they will be the indirect beneficiary. But one point will be prominently visible, likely to be visible for especially for BFSI sector is the deposit growth rate. We believe that there will be more and more action possible towards the increment of the deposit growth rate. Excuse me, increment of the deposit growth rate in the upcoming budget. So in that perspective, BFSI sector will be in traction. Coming down to BFSI power capex company like PFC, REC as a power proxies will continue to remain focused because we believe that power will be the biggest agenda likely to put up in the upcoming budget. Coming down to chemical and fertilizer. So chemical and fertilizer, there will be more focus will be given towards the battery manufacturing, and based on that, battery manufacturing companies in the specialty chemical will continue to be remain into the focus. More and more steps will be given towards the manufacturing. There could be possibility of additional PLI will be given for the battery manufacturing in India. Coming down to niche mid-cap opportunity, what we believe that every time the government focus will be towards the green energy, the green technology, towards the recycling and more renewable technology. What we believe that again in this budget, more focus will be given. So VATech Wabag as a water treatment, or the focus will be on the water treatment or water reclamation. Gravita as a recycling player. Anthony West as a waste management treatment. Jain Irrigation will be as a pipe company for the rural irrigation system. So we believe that all these niche players will continue to be remain in focus in the upcoming budget. Coming down to FMCG and retail. So this is a very classical sector which is showcasing a consumption slowdown, and the biggest ask and from this sector is steps to take for boosting consumption in the economy. So any steps taken towards the boosting of economy will be the welcome step for the FMCG and the retail company. What we believe that there would be a good upgradation possible, or some upgradation possible in the new tax regime of higher standard deduction, or there could be possibility of increasing the slab of nil tax. If the number is equivalent to 10, up to 10 lakh, no tax will be given. So it means that that will be the clear sign towards increment in the FMCG and the retail demand. What we believe that in that scenario, all the retail company along with the QSR company, all along with the FMCG company will be the biggest beneficiary. On top of that, any steps will be taken towards the increment of the income levels of the masses will be the biggest beneficiary for FMCG and retail. In terms of auto and auto ancillary, same phenomena. Anything which is related to the increment of the income level of masses will be the biggest driver for boosting rural and the urban income, will be the beneficiary for auto and auto ancillary. So we remain vigilant on that. On top of that, the EV supply chain, the EV ecosystem, any development towards the EV ecosystem will be keenly watched by the industry. On top of that, the commercial vehicle, the scrapping industry. On top of that, any steps will be taken towards the reduction in the logistic cost of the overall economy from 12% to 8% will be keenly watched by the economy. So all these things will likely to boost auto and auto ancillary companies. So more and more steps is needed. So any steps to spur consumption, the auto and auto ancillary will be the indirect beneficiary. Excuse me. So metal and mining in terms of direct beneficiary from the budget, as the capex spending increase, the more infrastructure will be built. For in building more infrastructure, more metal will be used. So they are the indirect beneficiary. Any increment will be given, they will be the indirect beneficiary from the budget. In terms of real estate is the biggest driver of consumption in the Indian economy. What we believe that this time around there would be more steps will be given towards boosting consumption in terms of real estate cycle. What we believe that there could be ease of doing business, that could be related to some amount of reforms in the real estate. All these will be the welcome steps by the real estate players, and what we believe that this time around more steps will be given towards the real estate. We prefer Prestige and Oberoi. in the listed player. What we believe that data center is the next big opportunity. There could be a possibility of data center to include it as a part of SEZ. So we remain vigilant on the data center to boost consumption in the real estate and improve the housing loan. There could be a possibility in the ATC. There could be a possibility in the old regime. The 2 lakh interest deduction limit could increase to 4 to 5 lakh. That is also possible in the upcoming budget. So that will again be the biggest trigger for consumption going forward. So all triggers related to consumption, we remain vigilant on those triggers. Coming down to pharma and healthcare. So for pharma, it will be a neutral thing, but for healthcare, it will be very, very vigilant from the upcoming budget. For the medical tourism, for spurring the medical tourism. Now we believe that the private hospitals are the best play for the Indian consumption story in terms of hospital consumption story. Right now we are seeing that this story is playing in a very, very right way because the insurance penetration has increased significantly. On top of that, the oncology and the heart care treatments are increasing at a double digit rate, and there is a third lever behind the success of the Indian private hospital is the medical tourism. Now there is the medical tourism in terms of 7 lakh patients have visited in India in FY19 as a part of medical tourism. During the year of COVID, we have seen dip in the medical tourism, and from that point onwards, year on year, the number of medical tourism tourists are increasing. Now in FY25, it is again likely to cross 7 lakh customers. What we believe that the government will provide more option or more and more promotion towards this medical tourism. So more steps are needed to boost the consumption in terms of medical tourism. So that will be the beneficiary for the private hospitals like Fortis and Max, and Lupin and Dr. Reddy as just a play. At last, hotels, travel and tourism. What we have seen that from last couple of years increase their agenda towards boosting consumption towards travel and tourism. More and more travel park, more and more demand is created. Currently, we are also ongoing event in which Mahakumbh in Uttar Pradesh. So we believe that there will be more and more steps needed to strengthen the travel and tourism industry. Hospital sector demands for infrastructure status, which will be beneficiary in terms of taxes, in terms of faster approvals, and there is a demand to increase LTL limits. So all these steps will be the welcome steps for the industry, and what we believe that Indian hotel, the one of the biggest hotel chain industry in the listed space, will be the biggest beneficiary of all this demand. So all in all, it will be a balanced act between the capex spending and the social welfare scheme. We believe that this budget will help us to increase the consumption demand, and what we believe that with this our economy will back to the track of economic momentum. With this, I'm ending my presentation. So happy investing, happy time, and let's hope for Umido Wala budget. With this, I'm handing over call to Rohit.
So thank you, Neeraj, for such a great insight.
To all our participants, that if you have any queries, anything, then you can directly put in the chat box, and Mr. Neeraj is there, like who is going to help you out. We're going to answer the queries. So those who are attending our session from our YouTube channel, they can type the questions in the live chat sections, and those who are attending this from our WebEx, on the corner side, you can see the chat section, and you can type your queries there.
oil and gas sector is currently more vigilant towards the US economy, how the US economy will behave in next couple of quarter. So the oil prices will be more driven from that area and more vigilant from that particular economy, because the new president Trump is now igniting towards the fossil fuel rather than the renewable energy. So they want to drill more oil from the US economy. So how the US oil dynamics will behave in next one quarter, how OPEC will behave, so that remain vigilant. So it will be more driven towards the oil prices going forward. So not related to the budget. There is a second question. What is your take on the IT sector? So IT sector is in a very interesting time. So right now, the downgrades in the IT sectors are limited, and that is the reason IT sector is standing out in the current volatile macroeconomic environment, and that is the reason IT and pharma are the standout sector as compared to the volatile other sector. What we believe that IT sector, the valuations are no longer compelling because the other market has been corrected and IT we have not seen the correction. Now there are 2-3 things related to the IT sector, because the IT sector is having the revenue coming from the bigger economies like UK and US. In US, there are strong chances that the economy will grow from the current level, and there is a possibility of corporate rate cut in going forward in the new Trump presidency. Till now, we are not sure when this will going to implement, whether this is going to implement in FY26, whether this is going to implement beneficially in FY27. It is a question of time. But so based on that, there will be a volatile time for next 1 or 2 odd quarter. But if you have a view of next 2 to 3 year, IT sector will be the biggest beneficiary in the Trump presidency. So view on NBFC. So right now NBFC are the clear buy, because we are on the verge of rate cut cycle going forward. 1 to 2 rate cut possible going forward in the remaining part of 2025. And what we believe that NBFC could be the beneficiary, because there will be a NIM expansion story possible in the selected NBFC. So what we believe that NBFC who are targeting towards the housing, targeting towards the vehicle finance will continue to remain attractive in the current juncture. So there is one very interesting question. Hi sir, I am Ashish. Thank you. It was a great insight about upcoming budget. Can you please explain the reason for the current market crash and what could be the trend? So the reason which I already explained in my initial perspective once again. Right now market is not looking for the domestic or the ongoing earning season. The market is looking at the macroeconomic event. The biggest macroeconomic thing which is happening in the US market. During the first week of November, we have seen that the President Trump has won the US election, and their swearing in happened on 20th of January, a day before yesterday. Now, what we believe that after winning the US election, there is a dramatic change in the US 10-year bond yield. We know that US Fed has reduced the interest rate by 100 bips, but the US 10-year bond yields were behaving in a different way. It inched up by almost 100 bips. So one point, the US Fed is reducing the interest rate and their bond yields are inching higher. So that is a very rare scenario. It means that there is a 200 bips divergence in the interest rate and the bond yields. When this type of rare scenario happens, it means that the money is going into the 3-month treasury of the US economy, and that 3-month treasury is attracting all the global money. And that is the reason constant FI is selling not only in India but across the emerging market. because their domestic country is giving risk-free rate of 4.87% for the 10-year bond yield. And that is the reason they are attracting money. And based on that, we have seen that the dollar index inch up to 110 level. Now, what we believe that it will be a short term because this due to the due to uncertainty of the inflation trajectory, what we believe that in next couple of days we likely to see smoothen down in the bond yields, which already started from last one day. Once the bond yield and the dollar index settle, we will again back our focus to the domestic macroeconomic things, that is the earning season and the budget. So next couple of days could be remain crucial, but what we believe that very soon we will again back to the normal.
So Neeraj, we are having a few questions from our YouTube channel also. So
yeah, please.
First question is that what's your key takes on semiconductor manufacturing and which companies look good one? And second is from the Soul Alone, that is what is the future of chemical sector?
So remain vigilant on the what amount of allocation will be awarded in the PLI scheme in the upcoming budget. So based on that, there will be the new thing likely to emerge. What would be the second question? Rohit, what would be the second question?
The second question is that lot many energy power and power distribution companies are coming in. What is the future of them?
So the power and distribution company will be the biggest thing which likely to vigilant in next 3 to 5 years. We remain bullish on this particular sector. So what we believe that transmission will be the biggest theme for next 3 to 5 years, because we are seeing that government focus is on generating renewable power, and to distribute that renewable power to grid, transmission lines are required. So we remain bullish on Kalpataru projects. We remain bullish on Skipper Limited for the transmission, and we are, and in terms of manufacturing, we are bullish on JSW Energy, because battery storage will be the biggest area, and more allocation and policy definition will likely to be visible in the upcoming budget.
So thank you, Neeraj, for giving such a great insight. And I believe many of our participants they have been attentive and posed their queries also. So if you have any questions, any queries related to the stocks or related to the budget, request you to please post in the chat box. So we'll wait for a 30 seconds or a minute, and we'll take the queries.
Over. The only thing is that there is a valuation concern in that particular space, because valuation has increased as compared to what was the fundamental. What we believe that the first half of 2025 is likely to be more volatile. The concerns which I already highlighted. The second half will be more concrete development will be visible in the entire market. So for the entire market, so first half likely to be more volatile. So that's why more volatility likely to be seen. But second half onwards, we will see more concrete development will be building and PSU will development.
Thanks for joining